So the euro is in the process of consolidating after breaking that neckline of a key major head and shoulders top formation that potentially opens the door all the way for a drop down towards 112.30. At this point, next key level of support comes in by a minor head and shoulders top objective going back several days off the 2017 high. That high at 2093, there was an initial head and shoulders top that triggered on the break below the 50-day moving average on the 25th on 25th and 26th of September. That targets 115.55. You can see it right in here. So that's the next level of support below. We do have the 115.75 low from the previous week, but with 115.55, that head and shoulders top objective right there below it at 115.55 is the important level to watch below. And then above, we've seen some consolidation, and so if the market can close back above 116.60, then it might alleviate a little bit, for now at least, the short-term downside pressure. Overall, however, following the break of this neckline, the pressure is on the downside, and the market would have to break all the way back above the right shoulder at 118.80 to negate the current downside pressure. So while we could see some bounces in the euro, the market right now is just consolidating, and while it holds below the right shoulder, there is still risk for additional downside in this market towards 112.30. Again, the next key support level for this market is that 115.55 minor head and shoulders top objective. Sterling dollar. So cable has been confined to a consolidation over the past several days. The market had put in a nice little rally, but overall you can see there's a lot of chop going on in here, and we need to see it close back above 133.40 or below 130.25 for a clear directional insight. Dollar yen. So dollar yen has been pushing up towards its major range high over the past several months. You can see right here that going back to earlier in 2017, the market's been seeing some choppy up and down trade. Right now the market is sitting up by the range high. If we see a break above 114.50 or even 115, then that could suggest that we're seeing a bit of a shift in the current structure, but inability to establish above the 115 area will keep the possibility for this range intact, and the possibility for another topside failure here and a resumption of declines back down towards the range lows. Key support for this market right now comes in by the low that we saw on Tuesday. That low is at the 112, around 112.95. Euro Swiss. So Euro Swiss is continuing to push higher. Fresh 2017 highs recently at 117.13 about. The market is looking like it wants to push up towards a retest of that previous major base going back to 2015, January of 2015, before it broke down at 120. Any setbacks here should be very well supported, ahead of ideally into the 114 to 115 area, while only a break back below 112.60 would compromise this current upside pressure that we're seeing in Euro Swiss. Aussie dollar. So Aussie dollar right now is pressure to the downside, and if the market consolidates or sees a little bit of a bounce, it doesn't really mean much as far as compromising the integrity of what has been this now downside pressure. The market would need to break all the way back above 79 to suggest that we're seeing sort of a reversal back to the top side. Until then, look for rallies to be well capped, ideally ahead of 78, in favor of the next downside extension towards a measured move objective, which comes in at 75.50. Dollar CAD. So dollar CAD has pushed up over the past several days out from the plus 2-year low after stalling just shy of a psychological barrier at 120. From here, there's risk for continued upside to retest that major psychological barrier at 130. Any setbacks that we do see here, and we could see some short-term setbacks with daily studies stretched, should be very well supported ahead of 125. Kiwi dollar. The New Zealand dollar is consolidating just off its recent 2017 low. Remember last week we just touched that 2017 low from May, matching it, and so we're consolidating off that low, and the market is looking a little bit stretched, which could warn of a bit of a short-term bounce, but overall the downside pressure here remains firmly intact. Any rally should be very well capped, ideally now ahead of 71, in favor of that next downside extension to fresh lows, potentially exposing the 65 barrier further down. Only back above 72 at this point would compromise this outlook. SPX 500, the S&P 500, another day, another record high, the market pushing up to close to 2600, which is that next key level above. We're in uncharted territory here, of course, so that figure at 2,600 is the one to watch above. As far as support goes below, we would need to see a breakdown and a close back below 25.44 at a minimum to take the immediate pressure off the top side. Gold. So gold has been very supported over the past several months. The market has gradually been trading higher, and so this latest round of setbacks are expected to be supported yet again in favor of the next major upside extension back above some resistance in the form of the 2017 high at 1357, which will then expose a break above the 2016 peak at 1375 further up. Only back below 1200 would compromise the constructive outlook for gold.